All right, well, we'll get started. I appreciate everybody coming today and looking at what we're kind of seeing in terms of the current outlook. So I'm going to talk briefly about corn, soybean, a little bit on cotton and wheat, but mostly on corn and beans in terms of what we're seeing right now for current market conditions, and kind of look at what we might end up seeing moving into the fall. And so the first thing that I want to end up doing is quickly just kind of give a recap of how we got to where we are. A lot of this is going to be kind of old information, but there's a couple of important takeaways that I think people should kind of recognize when we're talking about how we ended up getting to where we are right now. And so when we look at corn, I don't want to kind of beat a dead horse or pick on the USDA for poor estimates, because they have a thankless job and it's almost impossible to project where some of these numbers are going to come in. But what really ended up changing between, if you think back to May of 2020, we were in the middle of COVID. There was lockdowns. There's a lot of pessimism in the market. They're projecting a 320 market price, and where they really missed, and this is all for the 2020-21 marketing year, so the 2020 crop, where they really missed was on the production side. And there's, obviously with the windstorms that came across the Midwest, flash drought issues, China imports on the demand side, they did end up missing pretty substantially on the supply side. And one of the things that I hope people take from this is, again, if you look at where we are right now, we're in roughly the same time period, only for the next marketing year, how quickly things ended up changing. And so again, I'm not saying that that's necessarily going to happen, but we always have to remember that things have the ability and the likelihood of changing dramatically from where we see them right now to where they're going to end up as we move through the marketing year. The other one that I think is also important is that the story is very different. When you look at corn, for example, and the miss on the supply side because of some of the issues that we had domestically, that's not the same as what ended up occurring for soybeans, for example. Yes, there was a miss by the USDA where we've seen a tremendous change in price expectations from May of 2020 to May of 2021 for the current marketing year. But a lot of that was driven actually by the higher demand, both on the domestic crushing side and on the export market side, which is super important to end up looking at, because that's one of the ones that's going to really influence prices moving forward, is what's going on in terms of the demand. That's really going to drive price direction as we move forward. The other one that I always like to point out when I'm showing some of these supply and demand tables is marketing year price and futures price or cash price are not the same thing. That marketing year average price is a composite for the entire marketing year. So the entire marketing year of the product or of the commodity, so that we need to end up translating that into what maybe our typical cash prices are. So in Tennessee, we will typically be substantially higher than where these marketing prices are. But again, it does give us kind of a benchmark as we end up looking at what our price direction is. But again, on the soybean side of things for this past year, a lot of that was driven by demand. We see strong demand moving into 21-22 marketing year as well. When we look at cotton, I'm not going to spend a lot of time on cotton, but a lot of that was, again, a production disruption where we had Texas acres down, we had drought, we had hurricanes that dropped everything down. The other one that I do encourage people to look at if they're interested in kind of the stocks to use, I think that's a really telling statistic in terms of the fundamental analysis, how much we have in reserve relative to how much we're using. And you can see for all four of these commodities, just a tremendous decline from the initial estimates to kind of where we are right now. When you look at something like cotton, for example, going from 40.7% to 17.8%, that's a tremendous move in terms of stocks to use, and obviously is very supportive towards pricing. When you end up looking at wheat, wheat is a little bit different story. It is, I mean, all commodities are truly global, but there are other larger players on the world stage. And so what really, besides corn prices increasing, what really drove the changes in wheat was a contraction in foreign stocks and global stocks in general. And so that's all I wanted to say about this past marketing year. So just kind of, some concluding thoughts on this is, COVID did contribute substantially to the uncertainty, probably lent it to some of the larger misses in terms of USDA production. Export demand, particularly from China, was much greater than anticipated. On the positive side, it looks like that's something that we're going to continue to see as we move into 2021, 22. You always have to be a little bit I guess, skeptical when you're dealing with numbers out of China. It does look like this strong demand is driven by kind of the use, but there's always other layers to things in China, and it can be difficult to get the true story going on out there. We did see dramatic reduction in production and supplies in the US from July and September last year. And again, one moving into 2021, 22, we are at a much lower stocks level than we were this past marketing year. And so that is going to be very supportive for where our prices are at right now. And again, the last thing that I do want to point out again is the USDA and market projections are imperfect. We can see things change very rapidly. So again, trying to end up taking some of that risk off the table and protecting yourself against potential losses, I think is so important under these volatile circumstances. So as we look forward, that's kind of a quick recap of where we've been this past marketing year. So when we're looking to the 2021 crop, marketing it through 2021, 22, there's numerous factors. Obviously, this isn't all inclusive, but here's some of the more important ones that I think is really going to dictate where we're going. Continued global economic growth, greater export sales. Do we see drought emerge here or in other key production regions? Do we end up seeing, some of the trend line yields are above that the USDA is currently projecting? Do we end up seeing improving weather? And do we end up seeing any geopolitical issues that would potentially affect what our trade relationships are? So when we looked at 2021, 22 marketing estimates, this is the May estimates. They'll update their June ones on Thursday. So, we'll have some new numbers. I don't anticipate major changes to this, but I did want to kind of point out just a couple of numbers that I thought kind of jumped out to me. That trend line yield for the US, they still had that. And again, they use the USDA uses a trend line yield, but it's weather adjusted. And so I still found it a little curious that they were going to end up having it just under 180 bushels per acre in terms of national average yield. So I think that's one that, is going to be worth watching. To me, one of the big considerations as we move forward is going to end up being what ends up happening with the acreage numbers. We'll get some estimates at the end of June here, but I think that's where we'll really potentially end up seeing kind of a little bit more clarity on where our initial starting point is. Obviously, there's a limited number of acres, and how that is allocated across commodities is going to be super important. The other one that I did want to point out is just on the soybean side. You'll notice that the exports are actually lower projected for the 21-22 marketing year than this past year. And again, that's not a function of demand. That's a function of, we might not have enough supplies to maintain or increase that export amount. So again, there's still a very robust demand draw, primarily from China, that's really affecting this. When we look at kind of the weather conditions right now, I've got the US drought monitor and then the calculated soil moisture anomaly for the month of May. And I don't think there's a lot of surprises here for anybody that follows us. There are some issues up in the northern plains. Me and Andrew were discussing before many got on that we did see some positive moisture up in that region. But again, everybody knows that rainfall does not solve the drought anomaly. And, as we progress into our key pollination and filling stages, that moisture is so important. So again, there's still a lot of uncertainty hanging over the market in terms of what's going on with weather for this crop. So again, that's going to continue to be an issue through the summer. I mentioned the stocks to use ratio. I do just want to kind of quickly touch on this. And again, we always have to translate these to, what is our cash price? This is a marketing year average price. And so again, we need to end up looking at it through that lens. But I do want to give just, some context to where we've been in the past relative to stocks to use and where we are projected for the 2021 crop. So right now for cotton, for example, we're projected at 18%. That would translate into a national marketing year average price of about 72 cents with a reasonable range of somewhere between 60 and 81 cents. When we look to corn, Again, where we're at projected at right now for the USDA is 10.2%. That would translate into about a 450 national marketing year average price with a reasonable range of 5 to 550. So for corn, for example, when you look at a national marketing year average price of say 550 in Tennessee, we're usually above what the national marketing year average price is. And again, you can't just pick it as a point in time. It is the average for the entire year. So when we think back to 2020, one of the things that's so challenging with that is if you think back to May of 2020, we had very low prices and then they ran up all through the year. And so again, you do have to end up looking at the marketing year price for what it is. So when we start the marketing year, it's not going to be what it is when it ends. So again, it's an average based on how people market their crop. But again, what I do want people to take away is the price, or where we are in terms of stocks to use right now, is very supportive for maintaining prices close to the existing level. It's not to say that they're not going to go down. I think there's going to be continued volatility, but I do think that there is, from a fundamental standpoint, some support for prices near current levels. I don't see us dropping down the way we did, or potentially going back down to where we were, say, at the earlier part of last year. It would take something very unforeseen for that to end up occurring. It's not to say that we can't go down a little bit from where we are. I think, there's going to be a lot of factors that are going to end up dictating that: acreage, yields, all those types of things. But again, right now we are in a place where it is supportive for prices moving forward. Soybean, similar picture, where you're looking at a potential marketing year average price somewhere in that 10 to 13.75 range. So again, we still do have a lot of underlying fundamental support for prices across most of our row crop commodities. Wheat, similar thing. Wheat, you have to be a little bit more careful with it just because there are the different classes of wheat, and then we always have substantial global competition in there. Pretty wide range, again, that 490 to the 670 range in terms of marking your average price. So when we look at where prices are currently, I like to look at a host of prices. Each one of these prices can tell us a little bit something different. So the first one is just the Chicago Board of Trade, or ICE futures price. And I pulled these as of yesterday. When we look at harvest futures, corn at 606, soybeans at 1455, cotton at 85.99, and wheat at 681, all substantially higher than where the marketing year average price is. But again, you do have to put that into context. I pulled FAPRI's March estimates. They're a little dated, so I'm sure that Pat and his group will revise these up based on current market conditions. And then I did pull the Tennessee average harvest cash forward price at elevators and barge points. And so, at 582, 1410, and 690 for corn, soybeans, and wheat. Again, obviously, these are cash forward for harvest delivery. So we do have to end up taking that with a bit of a grain of salt. They are, for the case of corn and soybeans, showing a negative basis, which typically, we would expect to have a weaker basis during harvest with a stronger basis at other times of the year. And then I put the WASD price on the bottom there. So, it is important to kind of look at how these price relationships are looking. So when we look at current futures, I just want to kind of show some of the volatility that we've seen in the markets. Obviously, when we look at corn and soybeans, the trend for the November futures has been up dramatically compared to where we were in 2020 and 2019. But we have seen some days where, a lot of tremendous price swings where we've seen, 20, 30, 40 cent price movements. We've hit limit a couple of times. So again, that can be really gut wrenching when you're looking at it from a marketing standpoint, to see that type of daily movement. Obviously we love it from a crop producer side when prices are going up, but to watch those go down. And I think that highlights the importance of using some of the risk management tools that are out there to maybe take away some of that downside protection, or to end up looking at pricing some of your production to take some of that risk off the table. When we look at basis, this is one where we have seen a very strong basis. This is for soybeans when we look out for the month of May at 45 over. And again, these are specific to elevators and barge points, so it's not going to take in any private contracts, or on the corn side of things, any sales to poultry companies or that type of stuff. So you do have to end up adjusting it for where you're marketing those. I've heard several people tell me that they've had much stronger basis than what's showing here. But basically, what I want to point out here is the trend over time. This goes all the way back to January of 2013, kind of shows, from that 2017 through 2019, where we had some of the trade war with China, abundant supplies, where we've seen that very strong negative basis. Now we're in to a set of circumstances where we've got that higher basis. There are some pretty big differences between soybeans and corn in terms of basis. We do get a seasonal pattern. You do always have to be careful because every year is a little bit different, but the red shows the 5-year seasonal average, and you'll see, obviously we typically have a weaker basis in our harvest period, September, October. And then you do see the influence in the 5-year average of South American production, where we see that decreased basis in March and April as well. Where we're at right now, I don't suspect a lot of people have a lot of soybeans left in storage. I think the high prices have really pulled most of those reserves out. But there is tremendous price offerings for old crop right now, based both on the futures and on the basis level. When we switch it over to corn, again, we've seen the highest basis reported elevators and barge points since about July of 2013, and that was coming off that intense drought in 2012. So again, it's one of those ones where we are seeing some real positive price offerings. And I've spoken with people that have been marketing to poultry companies, and I've heard some guys talk about getting 70, 80 over. And there's two things I will say about that. I mean, obviously that's not going to be for all the bushels out there. It's going to be a limited number of bushels, but it does highlight the importance, particularly in Tennessee, of being able to store our commodities and take advantages of these seasonal increases and this kind of on-call demand that is out there. We have tremendous demand for our commodities, particularly corn, and we really want to try to be able to take advantage of those. And so when we look at kind of the seasonal trends in corn, obviously this is kind of what we'd end up anticipating, is again a bit of a weaker basis during the harvest interval, but strengthening pretty much throughout the summer. Whereas right now in 2021, again, we're approaching that 70 over as the average. And so, and this is elevators and barge points. So when you're talking about private sales, you can potentially expect that even a little bit higher than that. So when we look kind of moving forward, what's really gonna influence price direction? One that I think is going to be really important. We do obviously have the WASDE report that's coming out tomorrow. I don't see that one as a major price mover because they're not going to really update the acreage numbers. They might tweak a few things, and it will be important to kind of look at where their export demand numbers are, but I don't see that one as a major price mover. The one that I think is going to be much more important is going to be that June 30th acreage report. I think that's really going to give us an indication of what the allocation of acreage between our spring planted crops are going to be. I'm really interested to see how that dynamic between corn and soybeans plays out, not just in Tennessee, but across the U.S. I think that's going to be super important as we look at what the marketing potential for those crops are as we move in. The other one that is going to be challenging is if we look at cotton. I don't know how that's going to play into the acreage out in West Tennessee. Obviously those that are heavily invested into the cotton infrastructure and industry are going to continue to grow cotton, but some of those periphery acres probably got pulled into corn or soybeans just because of the price differential there. When we look at weather moving forward, obviously South America is a very important export competitor. They've got some issues down there with the lateness of their corn crop and having some drought concerns down there. So that's one that's going to be very important to see how that finishes up for their second crop. When they're doing their second crop corn, they'll be harvesting that in July, August. So that'll be in competition with some of our earlier corn in the US. And then obviously, North American weather is so important, and it will have such a huge influence on where we see production moving forward. So, that's one that I think is really important. And just to kind of put it into context, when we're coming off of last year, we had really high beginning stocks. That's not the case this year. Our stocks are very tight for a lot of our commodities. And so production is going to be really important to see what that total supply is going to end up being for the upcoming marketing year. And so I think it's really, it's always important on production and understanding, where we are. But when we have these tight stocks, particularly on soybeans, but I mean, you can make a similar argument for corn and cotton. It is challenging. It puts so much more pressure on what the production is going to be as to what the supplies are going to be. And then, the one that always hangs over or tends to hang over these markets, both on the grains and on the meat side, is what goes on with export sales, and particularly China. Like I said, China is always so challenging. Their demand is very strong right now. They're importing all kinds of commodities. Where it gets a little bit more fuzzy is what's their exact reason for doing it. I suspect a lot of it is, demand driven, where they really do need, they're using as much, but there could be other reasons why they're doing things. Obviously they've got a history of stockpiling. I'm not sure they're necessarily doing that. Who knows what went on in terms of their production last year. I suspect that some of their domestic numbers were probably overestimated. I think they probably had a weaker crop than they were reporting. And so again, when we're looking at this in terms of uncertainty, there's a huge amount of uncertainty there, just because there's kind of a shroud of inaccurate information that comes out of there. And some of it might be on purpose, some of it might be just they don't have the advanced systems that we have to really estimate the crop. And then there's always going to be the natural variation, as indicated by when I showed those USDA numbers. There's just a high degree of uncertainty for these things. And then when we look at global production, the one that does kind of, not to be a rain cloud on the higher prices that we've seen, but when you see, $6, $7 corn, $14, $15 beans, there's going to be an incentive for people to plant. And again, I don't think we're going to grow our way out of the short supplies in 1 year. But it is something where this could have some longer term repercussions in terms of bringing in additional production globally, when we see the profitability where it is right now. So again, it's one of those ones where I think it's going to be interesting to see as we move, not just through this year, but through next year, what some of the consequences of higher prices are, right? We all like the high prices right now, but there could be some potential adverse consequences moving forward. And then, the global and U.S. economy are moving in a positive direction. How that ends up continuing to emerge, I guess there's a bunch of uncertainty there. And then, add in on that any geopolitical issues that might emerge between Europe, or particularly the U.S. and China. And I think there's a high degree of uncertainty there. So just as kind of concluding thoughts of where I see kind of markets going, I expect continued volatility. We've got some additional information that's going to continue to come out over the next month and through the summer, as we get, some acreage estimates, we get some weather. So again, I think we're going to still see some of these big swings up and down. We'll have to see where those numbers come out as to exactly where the direction is going to end up being. But like I said, we've got a pretty good base in terms of positive prices developing. It's not to say things can't change. Where are we going to stay at $15 beans and $6.50 corn right now? Well, we'll have to see what ends up happening, but I don't see us going down to $3.50 corn and $8 beans. I think there's a much firmer hard pan on the bottom. So in terms of sales, I think if you have 25 to 50% of your 2021 projected production priced, I think that's a reasonable amount. Obviously, if you have storage, everybody's going to be farm specific in terms of what they want priced and what they have the ability to store and market through the current year. So you have to take that into account. One that I have been saying, I've been saying this for a few months now, don't sell your way out of an extended rally. Like I said, there's things that are very supportive right now. And if we did get a weather event that was substantial, we could really see prices, strengthen even more from where they are. Now, I'm not saying that's going to happen. I still think it's prudent to get, that 20 to 50% price just from a risk management standpoint. But if you're starting to get close to that 80% of projected production for 2021 price, it's still pretty early in the year to do that. And you don't want to run the risk of selling your way out of the rally or pricing more than what you're going to end up producing, because we all know that we can get drought and production disruptions. It's going to end up doing it or reducing your estimated production. The big message that I have, I guess, is to protect the downside. There's numerous ways you can do. I think options is a fantastic tool. So if anybody's interested in discussing some of the strategies, one of the ones that I really do like, I'm not a huge proponent of using at the money put options. I think they're pretty expensive for the production that they take. But if you do want to, I guess, sleep better at night, looking at protecting that extreme downside, I think is worthwhile. There's definitely support in the market right now for higher prices, but if you really want to put in a hard floor on the futures side of things, I've threw up a couple examples of put options for December corn, November beans, and December cotton. So for example, a $5 put option cost you about 18 cents as of yesterday. And again, I wouldn't look at this as a way to end up increasing your price. I would look at this as similar to an insurance premium where you're paying for that protection and that peace of mind. I would look at it as, okay, the 18 cents is gone, but I do know that I've got a hard futures floor at $5. Or for soybeans, 12.60 hard futures floor, 12 cents. I'm willing to pay that premium to get that protection for the bushels that I want to end up securing. So again, I think that's just a something that can really help, because when you see these tremendous swings, and again, I'm not saying that these are the exact strike prices that we need to be looking at, but looking at those out of the money put options, I think can be really cheap insurance against a catastrophic decline in prices. Last two things, manage input costs and profitability. There's been a lot of talk of inflationary pressures and, getting building supplies. Like I said, I've been traveling this last month here. Lots of $3 gas. I haven't seen any $4 gas yet, but it's just highlighting input prices are substantially higher than where they have been. So again, when we're looking at from a marketing standpoint, we're trying to market for profitability, not necessarily just for price, right? So managing those input costs and trying to end up maximizing that profitability should be our goal. Last thing I just want to close with before I turn it over to Andrew is, decisions made during high price periods will determine how and if the farm will manage the next period of low prices. We all know prices are cyclical. We all know that it's great right now while we have high prices, but they're likely not going to be here indefinitely. So what we do right now is going to be very important as to how we make it through the next period of low prices that ends up coming.